Okay, this will be a short presentation on cost allocation, customer profitability analysis, and sales variance analysis. Cost allocation is concerned with assigning indirect costs to cost objects. Because we're allocating them, they're not traced. And indirect costs often comprise the largest percentage of the total overall costs, and it's for that reason that cost allocation is critical. Alright, so what are the four purposes of cost allocation? First, to provide information for economic decisions. Second, to motivate managers and other employees. Third, to justify cost or compute reimbursement amounts. And then fourth, to measure income and assets for reporting to tax authorities and perhaps to other authorities as well. Most companies have a six-function value chain: R&D, design, production, marketing, distribution, and customer service. In the traditional life cycle of how we make products or design them, think of them, design them, make them, market them, and service them, may not yield the cost necessary to meet our four purposes. So costs necessary for decision making at any of these stages may pull from some or all of these six functions. Alright, let's talk a little bit about criteria for cost allocation decisions. Ideally, we're interested in cause and effect. We're looking for variables that we can identify that cause resources to be consumed. Okay, and that way, when you present a cost allocation, it's the basis for the allocation and the dollars tracked, or the dollars that are allocated, become the most credible to the operating managers. And that's cause and effect is an integral part of activity-based costing. Benefits received is also a criteria, or one of the a criterion, I should say, one of the criteria for cost allocation decisions. The idea here is that the beneficiaries of the outputs of the cost object are charged with cost in proportion to the benefits they received. Okay, fairness and equity is the basis for establishing a price that's satisfactory to the government and its suppliers. So sometimes we see that used as a criterion for cost allocation decisions. And the idea here is that the cost allocation is reasonable and fair, and what is reasonable fair is then used as for establishing a selling price. The ability to bear is another criterion. Costs are allocated in proportion to the cost object's ability to bear them. So what this means is larger, more profitable objects receive proportionally more of an allocated cost. And the typical example of that is where we allocate cost based on the sales price. Alright, when we think about customer revenues and customer cost, we're moving into the area of customer profitability. And customer profitability analysis involves the reporting and analysis of revenues earned from customers and costs incurred to earn those revenues. So essentially, we're still concerned with allocation, only now the cost object are the customers or class of customers, some kind of grouping of customers. An analysis of customer differences can provide insight into why we're getting differences in operating income earned from different customers. And if we can understand why, perhaps we can use different approaches to maximize our operating income. Okay? Price discounting is the reduction of selling prices to encourage an increase in volume of customer purchases. So the trade-off is lower sales in return for larger sales volumes, or lower sale price in return for larger sales volumes. And discounts should be tracked by customer and salesperson. And the idea here is you want that kind of data so that you can do analysis to figure out whether the discounting programs you've put in place are effective for the company and are more profitable than not using them, or are they more effective than other alternatives you may have on the table with regard to customer pricing. Okay, customer cost analysis involves looking at the costs as they relate to the customers. Now, keep in mind there's a customer cost hierarchy that we can use to categorize costs into different cost pools, and they can be categorized based on different types of drivers, based on different bases, based on the degree of difficulty in determining cause and effect or benefits received relationships. Here's an example. We could have customer output unit level costs. So these would be costs associated with the actual units we're selling to the customer. And those costs go up as we sell more units. We could have batch level costs, and here the idea is cost associated to a number of products being sold. So if we have shipment cost and they buy in terms of a batch, that could be an example of a customer cost at the batch level. Customer sustaining costs are those involved with maintaining the customer for us. So it's not specifically tied to units of output or a batch. It's at a higher level of which I wouldn't call it extraction, higher level of thinking about the customer in a higher level of detail. It's an aggregated level. And then we could also have costs associated with the distribution channel itself. A fifth one would be corporate sustaining costs, and those too can have an impact and can be customer related costs. Now, there's other factors in evaluating customer profitability as well. We may want to consider the likelihood of customer retention, the potential for sales growth, the long run customer profitability, increases in overall demand from having well-known customers. Okay, all of these are factors that should be considered in evaluating customer profitability. There's another one too, our ability to learn from our customers. Now let's talk about sales variances. If we talk about a level 1 sales variance, we're talking about actual versus the static budget, right? What was the variance between actual results versus our formal annual operating plan or formal budget, also called a static budget? Then we can break that down into flexible budget variance, where we measure the difference between an actual result based on the flexible budgeted amount, which means we're adjusting what the budget amount should be as a result of differences in activity. With level 2, we would have a sales volume variance. At level 3, we would have a sales quantity variance as well. So we're going to measure the difference between actual and budgeted results as a result of unit sales. We could have the sales volume results in the difference between the static budget and the flexible budget amount. Okay, we also could have a sales mix variance. Let's talk about the sales mix variance. It measures shifts between selling more or less of higher or lower profitable products. So it's the whole idea of we sell a basket full of products, and what's the percentage of the total, and how did that change versus what we predicted when we based a budget. Okay, now this is a little bit hard to see, but the sales mix variance is solved by taking the actual units of all products sold times the actual sales mix percentage minus the budgeted sales mix percentage times the budgeted contribution margin per unit. So we're looking at, if you will, the relative impact of one item in regards to the whole group of items we anticipated selling. The sales quantity variance takes that's equal to the actual units of all products sold minus the budgeted units of all products sold times the budgeted sales mix percentage times the budgeted contribution margin per unit. And I really think we need to work through an example to get your handle on these concepts. Okay, but I'll briefly go over them. The sales quantity variance is the actual units of all products sold minus the budgeted units of all products sold times the budgeted sales mix percentage times the budgeted contribution margin per unit. And then there's market share variance, where we take the actual market size in units times the difference between actual market share and budgeted market share times the budgeted contribution margin per composite unit for budgeted mix. And here too, I think this is hard to understand just by looking at the formula. I think working through examples is perhaps the best method of mastering this. Okay, market size variance is the difference between actual market size and budgeted market size times the budgeted market share times the budgeted contribution margin per composite unit for budgeted mix. And market size variance can be calculated by taking the difference between actual market size and budgeted market size times the budgeted market share times the budgeted contribution margin per composite unit for budgeted mix. All right. Well, overall, let's make some statements about market share and market size variances. There's a limitation. Reliable information on the actual size and share of various markets isn't always available. But keep in mind, these are considered a level 4 variance. So it's essentially a decomposition of the sales quantity variance. In my experience, I have rarely seen this kind of analysis performed. However, in my experience, I haven't been a dedicated marketing analyst, and I think this type of analysis can happen in certain industries, and most likely those industries were ones outside of my particular experience.